Let's talk about compound interest. Warren Buffett calls it the eighth wonder of the world, but why is that? More often than not, we're so focused on the near future that we lose sight of our long-term goals. In a society where instant gratification is commercialized and forced in our brain, it seems like anything that doesn't include immediate gains and an instant lifestyle change is looked down upon. But what if I told you that there's a hidden gem that seems to be overlooked by 80% of this generation? That you can reach your financial freedom not through a guru course, a hot new online money-making trend, or even a well-camouflaged pyramid scheme. That you can be set for life just by understanding the concept of compounding. Compounding is the process where the value of your asset grows exponentially over time through constantly reinvesting your profit. Today, we'll dive into the two most common types of compounding in finance, which are compound interest and compounding in the stock market. And make sure to stay all the way to the end of this video where I'll show you how to maximize the power of compounding in the stock market. Compound interest in a bank's savings account is arguably the simplest and most popular way that people use to grow their money, but also it's not the most efficient way to do it. When you open a bank account, you'll realize that your money is automatically deposited to your checking account. And in a checking account, as we all know, your money won't increase in value, but you can transfer this money to your savings account where you're going to receive positive interest every month on the amount of money that's in your savings account. Banks typically offer from 0.5% to 2% yearly positive interest on your money. Now hear me out. 0.5 to 2% return on your money isn't all that much. This is partially why a lot of people brush off the concept of compounding and ignore it altogether. They say it's not even worth my time. For the sake of comparison, we'll still explore the option of compound interest through a bank savings account. Let's say that you saved up a bit of cash and deposit $10,000 into your savings account. This $10,000 is your initial investment, or if we want to use financial jargon, this is what we call a principal. On that principal, you'll earn, let's say, 2% interest every year. So by the end of the first year, you'll have a total of $10,200, where the $200 profit is what we call earned interest. Now, this is where the power of compounding comes into play. Compounding basically means that you earn interest on interest. So for year two, if you keep your money in your savings account, you'll earn 2% on your principal, which is the $10,000, and on your earned interest, the $200 that we made from last year. So you'll actually earn interest on $10,200 instead of only on $10,000. So by the end of year two, you'll have $10,404, where in the second year, you racked up an interest of $204 compared to the previous year's $200. Now, this might not seem like a significant change, but let's fast forward 30 years to see the power of compounding. In 30 years, your initial investment of $10,000 will have grown to $18,114, and your earned interest between the years 29 and 30 will be almost $360, which is $160 more than your initial earned interest that you first got. Although compound interest through a savings account works, the issue with it is that the interest you earn is so low that you don't reach the exponential growth in a timely manner. Granted, it's better than simply keeping your money in a checking account because at the end of the day, you did earn $8,000 by doing nothing. But let's explore an even better alternative, which would be compounding in the stock market. Compounding in the stock market is best explained through an example. So let's say that you have the same principal of $10,000 and invest it in a stock, let's call it XYZ. This stock averages 10% year-over-year growth. Now, the keyword here is year-over-year. So after one full year, you'll have earned 10% on your $10,000 principal, which correlates to $1,000 in profit. Now, if you remember, this stock goes up 10% year over year. Then for year number two, your stock XYZ will also grow 10%, but now it'll grow 10% relative to $11,000 instead of only $10,000. So by the end of the second year, your investment will have increased by $1,100 compared to the previous year's $1,000. This compounding effect, which is basically ROI on your ROI, will create a sort of snowball effect as long as you keep reinvesting your profits by simply not withdrawing any of the profits and leaving them in the account. So if we fast forward 30 years, your initial investment of $10,000 will have grown to $175,000. And between years 29 and 30, your portfolio would have grown by $16,000 in a single year. Now, mind you, if we compare that to the first year you made $1,000 in profit, and by year 30, through the effects of compounding and not touching your investment, you made $16,000 in a single year. Now, let's try out a real-life example. Let's take a well-established growth ETF like Vanguard's Mega Cap Growth ETF. This ETF holds 96 of the top growing US companies like Apple, Microsoft, Google, and Amazon. And its 10-year historical year-over-year returns is 14.25%. So with the same initial investment of $10,000, your money will grow to $544,000 in 30 years. So if we compare compounding in the stock market's $544,000 versus the $18,000 that you would have made by putting it in a savings account, you'll realize that it's much more worth it to take advantage of compounding in the stock market than just in a typical bank savings account. Just by doing a couple of hours of research and figuring this out, you would have made an additional $526,000 over 30 years. And that's why financial literacy is so important. So to avoid missing out on important opportunities like this, make sure you subscribe right now. But even ending the video right now would be unjust to my viewers, because you can more than double your potential earnings by just doing these two steps. You can either increase the amount of time that your money stays in your account, or you can increase the principal. So as we said before, time is a big factor when it comes to investing. For example, let's say that you decide to wait 10 years before starting to invest. Then your investment would stay in your account for 20 years instead of 30 years. So with the initial investment of $10,000, by the end of 20 years, you would have made $144,000, which compared to $544,000 in 30 years is a big downgrade. So just by delaying investing by 10 years, you miss out on almost $400,000. So the moral of the story is to start investing as early as possible, even if you don't have as much. Also, increasing your principal can be a game changer for your long-term earning potential. Let's say that you invest the same initial $10,000, but now you decide to add an additional $2,400 per year, which comes up to $200 a month for 30 years. Then, in this case, after 30 years, your initial investment of $10,000 plus the consistent contributions of $200 a month for 30 years is going to come up to $1,441,000. So by contributing an extra $200 per month for 30 years, you make roughly $900,000 more than if you decided to just put your principal without consistently contributing that additional small amount of cash. All this to say that you should definitely not underestimate the power of compounding, and that you should get started right now. Also, if you're wondering which investment account makes the most sense for you, make sure to check out my RRSP and TFSA videos where I talk about the pros and cons of each account. And if you learned a thing or two from this video, make sure to leave a thumbs up and subscribe for more.